Yeah, thanks so much, Tim. Really appreciate the opportunity, and thanks everyone for joining us. So today I'm going to give everyone an overview of the company and our place in the market within the industry, and also, most importantly, talk about what the future of advice looks like in Australia, something that we think is a very bright looking future. So Tim, if you could flick through the first couple of slides for me, the disclaimer there. Onto this first screen. I'll start with an introduction of the company. Well, look, we founded the company in 2010. We listed on the ASX in 2015. And when we first founded the company, our complete focus was on building a direct-to-consumer financial advice operation with all salaried advisors. And we did this very successfully, opening offices all over the country. We were profitable from our first full year of operation. As I say, we listed in 2015, initially under the Spring Financial Group name. So our ticker was SFL for Spring Financial Group Limited. We had a very strong dividend history, paying out some $7 million in dividends. And then, look, in the wake of the Royal Commission, we saw a lot of structural change in the industry, and it caused us to have a real rethink, because the impact of that structural change not only presented problems for our own operations, and that was trying to build a large branded operation of salaried advisors, but it also presented massive opportunity as we saw the disintegration of what had grown to be really a vertically integrated model, with the banks and the insurance companies really buying up all of what were previously privately owned dealer groups or AFSL holders with authorised representatives operating under them, to turn them into, in effect, sales channels. And this whole model sort of disintegrated in the wake of the Royal Commission. And we thought, look, there's a big opportunity here for us to take all of the intellectual property that we've built in having a very successful, large direct-to-consumer business, and apply that intellectual property across what was, a very large group of independent financial advisors or privately owned financial advisors that really were left homeless, a lot of them, with the banks exiting the space. And so we bit the bullet, and we sold off a bunch of our B2C assets, and it scaled back our B2C operations, and really launched ourselves headlong into wanting to build a very large dealer group model with independently owned financial advisors operating underneath licensees. And we did this through acquisition of a small dealer group called Wealth Today. We completed that acquisition in 2018, and when we completed that acquisition, Wealth Today had just some 42 advisors within its group. We followed that up through the acquisition of Sentry Group last year, and more recently Synchron Group. And this has seen us emerge now with some 600 advisors operating across more than 400 practices. So we've seen very significant revenue increases. We've been able to go through a period where we weren't profitable as we transitioned out of the B2C space into the B2B space, to come back to profitability with a good result for the first half of this year, and what we expect to be about the same sort of run rate for the second half. So a good profit for the full financial year, but really now, with the acquisition of Synchron being completed in March, heading to a very strong position for next year. So what does a dealer group do? Well, aside from providing the licensing for advisors that enables them to practice and deal with their clients, is we provide a full compliance and risk management framework for them. We support them with their ongoing education and training, technical support in the advice that they're giving, and we assist them with their practice management and their business development. So if you flick through to the next slide, Tim, thank you very much. We're on a mission to build the largest financial advice group in the country, and with 600 advisors, we've got some $16 billion or more of funds under advice. We've got a very large in-force annual insurance premium book of $360 million. I believe that makes us certainly the largest in the country there as far as an advisory network goes. And we write new insurance premium across the group of some 25 million a year. So for 2023, we're looking at around 170 million in gross revenue, and some $18 million of gross profit. So where we've positioned ourselves now is we have emerged as the largest non-institutionally owned or non-product producing financial advisor network in Australia, and headed only by the institutional operators of AMP and Insignia, who were formerly known as IOOF. Tim, if you flick through to the next one for me. So looking at our guidance then for 2023, those numbers there that I said, 170 million of gross revenue is what we're expecting, with a GP of about 18 million, EBITDA in excess of 7, and a net profit before tax of 5. We'll have a statutory tax calculation for next year that will probably see us report 4 million, and these numbers are without growth, which we are expecting through either further acquisition opportunities or natural organic growth. Whilst we'll have a statutory tax calculation to do, as the company's got good, it's in a unique position actually of having good carry forward tax losses to use, but also a very healthy franking credit account. So whilst we'll have a statutory tax calculation, as we won't be paying any tax for some time, yet we will be able to distribute fully franked dividends once we get back to a dividend position. So next slide for me, please, Tim. Just looking at the shape of that, what I mentioned, the unraveling of the institutionalised advice networks. The big six previously had 8,500 advisors between them. That's down to being concentrated in the hands of just Insignia and AMP now, and has since 2018 has reduced by 61%, whereas the top 10 non-institutionals are up by 62%. You know, they were sitting at around 2,000 in 2018, up to well over 3,000 now, with ourselves being at the top of that table at 610, followed by Diverger, Centrepoint Alliance, and Sequoia, and then Count Plus is the other listed entity down there at number 7, and you've got a number of privately owned operations there in Capstone, Lifespan, Fortnum in focus as well. So we're well on our way on our journey of wanting to build the largest network in the country. Just those two institutionalised networks above us. So next one for me, please, Tim. So why would one be investing in financial advice? Well, you know, look, we've seen a lot of advisors exit the industry. We've seen the banks exit the industry. We've seen the cost of advice to consumers go up, and we've seen an increase in the number of consumers moving out of the advised environment. So why would you invest in the space? Well, the interesting dynamic in all of this is demand continues to grow at a very significant rate. We're right on the doorstep of the largest intergenerational wealth transfer in history, with $3.5 trillion set to pass from one generation to the next. And the nature and the type of advice people are seeking and the demand for it continues to grow. So if you flick through to the next one for me, please, Tim. You know, it's reported that there's some 12.6 million Australians with unmet advice needs, and research shows about 3 million seeking advice in the next 12 months. So whilst there's less advisors and costs have gone up, the advice practices that remain are getting more profitable. We've got a shrinking number of advisors charging higher and higher fees to a smaller number of clients. And so it's a really interesting dynamic for the industry. And we've got a government that the previous government has come out and said that they're very keen to look at ways of reducing the cost of advice. And we've got a new minister that's come out and reiterated that. So we think the future is very bright. Not only are practices getting more profitable, but we think the regulatory environment's clearing the way for advisors to return to dealing with those lower value clients as well. Really is, you know, looking like a good future for everyone. So next slide, please, Tim. I think that wraps me up there. I'll leave that one up of the board there and I won't touch on that. And hopefully some people have got some questions that we can deal with. But just in terms of the board, we've assembled a very experienced group of operators to help guide the company. And collectively, board and management owns about 32% of the company. So, really aligned interests between the people running the show and all our other shareholders. So thanks, Tim. If there's any questions, look forward to answering them.
Yeah, there's quite a few questions here, Keith. One of the questions, you mentioned a new government. Now, will they continue with the quality of advice review that's kind of in play? And do you kind of expect some relief at any stage?
Yeah, look, it's a good question, Tim. Ourselves, along with 7 of our industry colleagues, put a joint submission to the Quality of Advice Review, and those submission dates closed off 2 days after the new minister was sworn in. So it was an initiative of the previous government, not due to report back until the end of the year. And look, really the Quality of Advice Review was all about cutting red tape to try and get advisors back to being able to service the lower value clients who have been left behind. I'm really encouraged to see that Stephen Jones, our new minister, came out, immediately hit the ground running and said, the first thing to say is he'd been the shadow minister for financial services, so he was well across the sector. And he hit the ground running saying, I think you could read between the lines and say, we're not waiting till December to cut all this red tape. We're going to act more quickly. And he basically said within the next 3 months, there's a whole bunch of changes that he wants to make to try and bring down the cost of advice. So that's really exciting for us. And I think the industry knows where it needs to go, and so does our new minister.
And Keith, there's been kind of lots of consolidation happening in the industry. You've been, as a listed company, very active in regards to 2 large acquisitions in the last 12 months, which you spoke about. Yeah. You're going to pause for now, and how do you see the industry playing out in regards to consolidation?
Look, I think from our own perspective, it's not like we're rushing to acquire dealer groups at any cost, but it's certainly part of our strategy. So we've got no immediate plans. The last acquisition we did was the largest privately owned network in the country and had been for some time. So we've gone sort of right to the top of the tree there. But there's definitely other opportunities about, and we think there will be further consolidation. I think one of the key things is there's a lot of pressure on the much smaller networks to be able to deliver propositions to their advisors that meet the complexity of what's required from them today. It's a very complex landscape from an education and from a legislative perspective, and the smaller operators are really being marginalised. I'm not sure that they necessarily present acquisition opportunities for us, but I think what you'll see is perhaps some of those smaller ones exiting the game altogether, which presents good opportunity for organic growth.
And you mentioned dividends, and I think you were referring to around $4 million or $5 million profit after tax. Do you anticipate you'll be paying a dividend in the next year?
Well, look, we've maintained our dividend policy, which is as and when cash is available for distribution and profitability is there for distribution, is that we'll pay dividends at least once a year. With board and management owning sort of 30+% of the company, nearly 40% of the company, if you take in all of the staff in the business, there's certainly alignment with shareholder interests. So as soon as we're able to, yes, we want to return to being a dividend paying stock.
And it's been a tough industry to be in regards to kind of advisors leaving the industry. You've had the AMP debacle. You've got the cost of advice rising. Can you improve the margin of the advisor, and why should people be bullish about this industry?
Yeah, look, I think some of the things I touched on there before, Tim, is any advisors that aren't running really profitable practices today just haven't modernised their thinking. It's a big part of having a strong dealer group like ours has been able to have the experience within the personnel of the business to work with. The key thing about us is we know how to run practices. Advisors tell us when they come to us from other dealer groups that a lot of these dealer groups have either forgotten what it's like to build a practice and sit in a room with clients, or they've never known it. And it's a key differentiator within our business is that we're very focused on everything we do, being from the perspective of being inside the practice with the advisor and in the meeting room with the advisor with their clients. And our view is that any advisors that aren't running highly profitable practices at the moment just need to modernise their thinking, and we can help them with that because the demand grows, and we're seeing our good advisors deal with less people for more money and more profit. That doesn't solve the social problem that the government's got of Australians being left behind who can't afford advice. And that's what we hope this quality of advice review will do, which just provides a further leg up for all of us in the industry. So we're very bullish.
And by having scale in terms of number of advisors, can you offer, beneficial synergies across the group in regards to technology and documentation and all those added services?
Yeah, incredibly so. Even though we're running the 3 brands still, Tim, in Wealth Today and Synchron and Sentry, what we do is everything on the back end that supports the advisors and their practices is that's all consistent across a brand, an internal brand that we've got called Wealth Advisor. So we get a heck of a lot of synergy out of all of the education and training we do, the documentation, our risk management framework. We've got the same people at back of office working right across the cohort with the advisors. And when you've got scale like we've got, the key thing is that the real intellectual property in the game is quite expensive to buy in. Our biggest cost is our personnel. And if you want really smart people in the place, you've got to pay them. When you've got a smaller network, it's very difficult to do that. When you've got a large network and you can amortize the cost of that IP across, a significant revenue stream, as you're able to provide advisors a lot better proposition.
Great, Keith. That's all we have time for. Nice to see you again. Have a good long weekend.
Yeah, appreciate it. Thanks so much. Really enjoyed it.